how do you know if someone is a vegan?
No idea.
They'll tell you again and again and again.
That's nice.
Now, getting on with our topic of dumbing economic things or economic terms for us today, my first question for Mr. Menon is that what's the difference between fiscal and monetary policy?
The first direct difference is that the monetary policy is prepared by a central bank in your country, while the fiscal policy is prepared by the Ministry of Finance in your country, in your respective countries, considering that you're a democracy. If you're an autocracy, I don't know. I mean, God save you. But usually...
So in our country, you mean, when I say in our country, it's India, you mean it's the RBI, Reserve Bank of India, which is a central bank, sets the monetary policy,
correct.
and the current government and its Ministry of Finance sets the fiscal policy. Is that right?
That's correct. In a sense, if you ever do get confused, money is printed only by the central bank. So monetary policy, which has money in it, is the policy prepared by the central bank, while the fiscal policy is prepared by the finance ministry and your finance minister. So think of these policies not as crazy things, but they think of it as a budget. So you hear budget in the news every year when this finance minister stands up and presents this 3.5 hour or 4 hour long document in front of parliament, and everybody usually goes to sleep like they should. But to dumb it down in its essence, we make monthly budgets because we're all earning in one way, form or another. At least I hope so. So how we would prepare a budget is we'd look at inflows, which is our salary or whatever source of your income is, and then we'd look at expenses, and that's how we'd prepare our budget. How much do we need to go through the month? But the government does it the other way around. They first mention what the expenses are, so they'd want to build roads, infrastructure, hospitals, schools, and so on and so forth. And so they'll need an X amount of money to do that. And then they go on to say how they're planning to raise that money. So that's essentially what happens in that speech. So then that's when they decide that, we're going to raise taxes, or we're going to reduce taxes, or we're going to sell some coal mines and auction it. So the government does it the other way around. So they look at their expenses first and then decide on their income. And
okay, so you're saying the primary income or cash inflow for the government is the tax paid by its citizens. Is that correct?
Not necessarily tax paid by citizens, but all forms of taxation, both direct and indirect taxation. So every tax, including the GST, which is not directly paid by the citizen, is a form of revenue for the government. So taxation is a huge source of income.
And also, I mean, this reminds me of the auction, for the 4G auction, the scams that happened.
Yes.
And then when you say such auctions happen, is this a source of income for the government?
Yes. So coal auctions, spectrum auctions, anything that the government sells, which is state controlled and it sells, it does it for money, and it's one of the ways that the state generates its revenue. So the other way, let's say for you and I to raise money, is go to a bank and take a loan, right? Or ask some friends and take a loan. What the government does simply is that it goes to the central bank and says, hey, I need more money. And so they print more money because the government can do that. So the banker to the government is the central bank.
No, there should be a catch somewhere, right? I mean, you can't simply print money at your will.
There ideally should be a catch somewhere, because that's when you have a healthy segregation between the finance minister and the governor of the Reserve Bank. Sometimes when those lines are blurred, then that's when you have ridiculous monetary policies that are just supporting the government, which leads to a crisis, like either inflation or deflation, which we'll talk about later. But essentially what's happening in Turkey, if you look at Erdogan, when he was not happy with who the governors of the central bank were, and if they were not toeing to his line, he would just fire them. So I think he had somewhere around 10 or 12 central bankers, like the governors of their respective central banks, fired in the last 24 months. So that's quite interesting. So in a healthy setup, you would have a separation where there is a discussion and a debate between the finance minister and the governor of the central bank as to why they can't go on printing endless money. Which brings me to monetary policy now. That one of the reasons why monetary policy is so important is that monetary policy is the mechanism which the central bank uses to monitor the supply of money that exists in the economy. So if they feel that there is a lot of money and we shouldn't be printing more money because it will just add to the supply, then they raise interest rates so that spending is reduced. And if they find there's less money, then they start printing more money so that there's no crunch of supply. So this ideally is what monetary policy is, and the central bank sets the rate of interest for other banks in the rest of the country to follow.
Yeah, this I've heard. It's called the repo rate, isn't it?
Yes. So
it's in points like 0.25 and I don't know the unit. So what does that mean?
Sure. So there are a bunch of rates. It's not just repo rate. So there's something called the bank rate. There's something called the repo rate. There's something called the reverse repo rate. Then there's something called SLRs, which is statutory liquidity ratio. So the RBI has a whole host of measures to control what these banks do. So essentially, bank rate is what the RBI sets for a bank in order, like, let's say a bank wants to borrow money. So the RBI is also colloquially called, or in economic terms, any central bank is actually called the lender of the last resort, right? Because let's say we have a bank run, which means that everybody wants to withdraw money, or let's say a bank in itself is going under because of bad policies or let's say bad corporate governance structures. So now where does the bank borrow money from? So the bank goes to the RBI, right? So when the bank goes to the RBI now and says that we need more money, we need more liquidity, not necessarily because of a crisis, but also let's say the economy is thriving, more people are taking out loans, more people want to build houses, buy cars and so on. The bank in itself would want to raise money. So when the bank borrows money from the RBI, it's called a repo rate. So it's the interest that the bank would pay to the central bank. A private bank or a commercial bank would pay to a central bank. Then there's something called reverse repo rate, is when RBI raises money from these banks, and then the RBI agrees to pay a certain amount of interest to these banks. So that's what, and these things that you told, which is measured by 3 point whatever percentage, there's something called basis points. So in the financial world, it's called bips. I mean, it's just called bips. So they'd say 45 bips or 5 bips or whatever it is, which means, so bips is just even more dumbing it down, that 1 basis point is actually equal to 0.01%. So when I say it's raised by one bip, which means its percentage terms, it's actually only increased by 0.01%.
Right, let's talk about liquidity. So you mentioned liquidity. This is quite a confusing term for me because I am primarily from the science background, and then when we say liquid, it's a different thing when you guys say liquid, isn't it?
Sure. So liquid essentially is a term that is very close to the natural sciences as well. Liquid is something that flows easily, right? So it's not rigid per se, unless it's frozen or something of that sort. So it's something that which is meant to signify ease of movement. So when we classify assets in economic terms or in the jargon of commerce, we classify assets into fixed assets, immovable assets, movable assets. So liquid assets are very simple. Things like cash, gold, stocks, anything that you can sell tomorrow and you can use that as a medium of exchange is called a liquid asset.
Or does it mean it just moves through people, and it can be handed over or exchanged. Whereas immovable assets, like which may I call solid assets, are the one which
Sure.
which is like
That's
land.
correct. That's correct. It just takes a lot more time. That's all it means. That, I mean, you can still make money out of land. Land is still an important asset, but just that the medium of transfer to get money out of it is harder. So cash is the most liquid asset one can possibly imagine, right? And then is probably gold, because you can very quickly exchange gold for cash. These two are perhaps for me the most primary form of what you would classify as a liquid asset. Of course, stocks are something you can do it as well, but the whole processing time, you have like T+3 days until the broker sets your account and the money is transferred to your bank in a mutual fund, etc., etc. But cash and gold essentially are the most liquid of it, as far as liquidity is concerned. But when we use liquidity in the context of this macroeconomic scale, what it means is how much cash supply is there in the larger economy. What's the level of liquidity? What's the extent to which cash and cash denominated assets pervade the market? So that's what it means when these guys use it in a macro context.
All right. So then I think you have introduced a new term called macroeconomics, and of course I must ask, what's the difference between macroeconomics and probably the opposite is microeconomics. So what's the difference?
Bird's eye view versus worm's eye view is simply put the difference between macro and micro. Both of these, it's also a little bit of a philosophical conversation about what is the macrocosm and versus the microcosm, and so it's got the similar outlook as far as economics is concerned. Macro is when you look at large factors that impact the economic function. So let's say political risk, Putin waging war in Ukraine, that definitely affects people's lives in both those countries and the economy at large. But at the same time, microeconomics is a contributing factor to the macro as well. So if a company is not doing well, if a sector is not doing well, then it doesn't contribute to the larger economy. So microeconomics is essentially, it's got a lot to do with the study.
No, can you explain microeconomics in terms of people's willingness to buy things?
So one of the reasons why that is classified within microeconomics is because it's ultimately it's an individual's decision and how that individual fits in to the larger economy. So behavioral economics and all of this come under microeconomics because of that ambit. So exactly, but like you mentioned, microeconomics also is the study of decision making, is to understand why people behave in a certain way, why a firm behaves in a certain way. So if you increase taxation, you see people spending less at collectively. But why do you choose to spend less? There's that study of that behavior. What makes me buy a specific product? If I'm buying a beer, I have 10 beers to choose from. But why would I buy that specific beer? So it goes a lot into rationality. It goes into seeing if people are rational in terms of their choice, what makes people act in a specific way. So all of this is microeconomics. But macro has nothing to do
so
with.
Broadly classify as, with one example, is something like a war, like the war between Russia and Ukraine, which is happening right now, could show macroeconomic trends and the policies taken on based on that, whereas microeconomics much more specific to individuals or a group of individuals, which becomes, for example, in a sector or in a company.
Yes.
So that's microeconomics, isn't it?
Yes. I mean, at the most fundamental level, you can classify it as macroeconomics studies national income, while microeconomics studies individual income.
So we'll move on to another keyword which we already introduced in the talk. It is inflation and deflation. So we for the layman, we have seen it as a number with a percentage attached to it. how does it affect? For example, you say the inflation, if it goes above 10%, something would happen. Now, how does it affect a common man? Like, how does inflation affect the prices of things like banana or onion, or things like your beauty soap, or Surf Excel? How does that affect?
Inflation is, again, it's got a lot of nuances as a term in itself, but at the broadest level, in terms of dumbing it down, inflation simply means an increase in overall prices, or just increase in price. Just keep that as inflation. So because it need not necessarily be increase in overall prices, right? So I can have just one product and one sector seeing a rise in price. So anything that has to do with a rise in price is called inflation. So why does this essentially happen, and is inflation a bad thing? So the simple answer is no. The inflation is not a bad thing. So if you don't have growth, you ideally wouldn't have inflation. But like you mentioned, what percentage is good or bad? That is the question. So if you have there's something called, the central bank always measures something called inflation targeting. Every central bank does that. In India, it has been between 3 and 6%. It can be 3. That's the room that they have, between 3 and 6%. So a healthy economy which is growing at a steady pace would ideally experience inflation at somewhere around 3 to 3.5%, which is acceptable. But anything beyond the 7 or the 8% figure is a cause of concern. So there can be, which is one thing that's very interesting, is that there are factors that would contribute to inflation more than other factors. Like, for instance, just an increase in fuel price would have subsequent network effects on multiple sectors, which would lead to an overall increase in price, simply because fuel was expensive, right? Because so automatically costs go up of transportation, logistics, and then related industries that depend on that fuel will automatically experience price rise. So that brings us to just one important topic in inflation, which is cost of input, or which is called cost push inflation. Very simply put, because it pushes up the cost of the product right at the outset. So that has a network effect on the entire economy. So that's why you see in the news when there's a rise in fuel prices, it determines elections. It creates a lot of chaos and confusion, and a lot of rhetoric also in the news channel. That, is it a good thing? Is it a bad thing? Are people able to afford it? People are not able to afford it. So the reason of concern as soon as fuel price increases is because of this. Because that has a network effect on multiple sectors that are dependent on it, and that will lead to an overall increase or rise in prices of other commodities. Which again brings me to your question about how does it affect prices of, let's say, Surf Excel or onions or bread. So there are some commodities or goods that are classified as essential commodities, right? And there's also this term, which, again, not to go into the nuances, that something like a bread, eggs or milk usually does not see a huge fluctuation as far as price is concerned. But one of the reasons why Surf Excel could cost a lot more is because, let's say, if Surf Excel is using something, a filtration process which uses a lot of petroleum, if the cost of fuel goes up, the cost of Surf Excel is going to go up. But otherwise, largely, your Parle G is still going to cost $2 and $5. Your bread is largely going to cost $20, and that remains relatively stable over a long period of time, which means somewhere around 7 to 10 years, there won't be a huge amount of fluctuation. But as far as vegetables and other things are concerned, you've got multiple factors coming in, because you've got hoarders, you've got people who hoard vegetables, you've got these middlemen who try to rig the market, create this artificial scarcity where you've got enough supply, but you just withhold it to give the presumption that there is no more left, which increases people want to buy more of it because they think that there's less supply. which drives up prices because the other man's always going to be willing to pay a little bit more to get his share of that commodity.
All right. So from my understanding, it's fuel price is one simple example where if it goes up, then say the lorry operators, they would refuse to transport things from point A to point B for the agreed upon price because obviously if fuel price is up, they would want more, which means it has that cascaded effect of price increase from point A to point B and everything else in between. So ultimately, the consumer who is buying the commodities from the nearby shop, they would see the price increased, and the shop owner would say, oh, the price increased because the guy who delivered, they increased the price. And if they ask them, eventually it will reach the point where the cost of price is just fuel price increase.
So just to add to that, because though I don't want to get into a lot of jargons, people might have this doubt that why doesn't cost of bread or something like that rise? People interested in that need to check out something called the Giffen goods, right? It's spelled Giffen, goods. So just typing that into a Google search would give them more context as to why those things don't increase substantially.
All right. So the next question was how would, say, the inflation is going out of hands, how would the government or the central bank intervene?
So two things. When you know that there's inflation, which would signify that the capacity of people to purchase it is high, right? Everybody's got the money, and that's why money in itself does not have value, because everybody is able to afford it, right? And even if the petrol went up to, like, say 100 rupees per liter, if demand is still continuing, which means that there is a lot of money in the market when most people are at least able to afford it. So what the state can ideally do is, again, this interest rates. So that's when you see banks raising interest rates. So now you have an incentive to keep your money in the bank and not spend it, because you're getting an interest on that money that's just kept there sitting idle, right? And that is one aspect of it. The second aspect of it is that if I borrow more than what is needed, so let's say I took a home loan for 7%, and then because inflation got out of hand, the government decides to raise interest rates, or the central bank decides to raise interest rates. Now that same home loan where I was paying 7% as an EMI is pushed up to 13%, or is pushed up to even 10%, and also I feel that crunch. So what I do is stop taking on more debt than what I can service. That would automatically curtail spending, that would automatically bring down economic activity, and so it will tame inflation to a certain extent.
Also, the borrowing has an effect on this, isn't it? Because if the interest rate is less, then people are willing to borrow more money from the banks, and which means they have higher spending power, which means inflation will keep going up. So the central bank intervenes and is like, sorry, you can't borrow at the same rate. I'm going to increase the rate now. You can't borrow anything. You can't buy more things. So inflation comes down, and when it comes down to a point, is that what is called deflation then?
That's correct. No, so deflation would be the contrary, where there's no money at all. So if the bank continues to raise interest rates beyond a certain level, what people would do is simply stop borrowing money. Then there's no money in the economy. Then which also means, so we've also got to understand this aspect of people, that not everybody is borrowing recklessly. Some people are actually borrowing money for engaging in business. So this comes with another important concept called productivity. So is your debt being used for productive purposes or non-productive purposes? So if you have many billionaires like we have in the country who would probably just borrow and spend it recklessly, that's not something that leads to economic growth. But if there's genuinely a person who's borrowing from a bank in order to start his business and increase productivity in the country, that is good sort of debt. So if the banks continue to keep that interest rate very, very high, which will reduce borrowing substantially, it would also reduce borrowing not just for purchases like of a home loan or a car loan, but people will even stop taking loans for starting businesses. That would create a short supply in liquidity, which would lead to a deflationary tangent, which would mean that the economy would start stagnating or it'll slump and it'll start going down. So that's the lever that the central bank has. It has to ease it and tighten it. So the US has a very, very nice term for that. They have two things called quantitative easing and quantitative tightening, which means that they ease it when they feel that we keep it at a low interest rate situation where it's fine, we let people borrow it, and then they start tightening the economy by raising interest rates when they feel there's excess liquidity and we are spiraling out of control as far as price rise is concerned. So if you see, what's very interesting is post the 9/11 attacks, because economics is also very largely based on perception. We had near zero interest rates starting from 2001. 2008 onwards, it became even less. It's very close to 0.25. That was the kind of interest rates that America was going through. And now you see after almost 2 decades, interest rates coming up, which shows you that price rise has been a big concern for America and the world economy at large.
All right. Now that we have spoken about the 2 decades in which obviously there was an important point in 2008 when the recession happened. So my next question is, what is recession in terms of economy?
So recession is, again, it's a very subjective thing, but it's also a technical thing. Simply put, recession is if the economy experiences a downturn, or if it experiences negative growth for 2 consecutive quarters, it's classified as a recession. 2 quarters in the sense 6 months of a year of measurement, it's classified as a recession. That's it. So when the economy experiences a downturn for 2 consecutive quarters or for 6 months in a year, that can be counted as a recession. Now, how grave is the recession is again very subjective. So if it's just 6 months and then the 7th month onwards, if there's a recovery, then it's fine. But there are cases where there's negative growth or stagnant growth for over 8 quarters or 10 quarters. And so that's a pretty bad recession. That's it. It's basically the downturn of an economy where the economy does not necessarily experience growth.
What happened in 2008? Just in simple terms, what caused it and then what was its effects?
So what caused it was, it's called the banking crisis, it's called the real estate crisis, it's called multiple things, but it's originally started in the US, where there was this very predatory way where banks kind of lended to people in a very reckless manner, right? And that caused this huge bubble to build up.
Sorry, we just discussed about the fiscal and monetary policy, and then was the monetary policy not strong enough that the banks were given a free run in terms of its operation?
More or less. When you say banks were given a free run, there are many governing bodies within the state machinery that has to regulate banks. So banks have a regulation. So something like your KYC, where the bank takes the details of who the lender is very important. In many cases during the 2008 crisis in the US, KYCs were not necessarily done, in the sense if any random Joe walked into a bank and wanted a house and they took a $300,000 home loan or a mortgage on the house, they just approved it.
Yeah. Just for information, KYC means know your customer.
Know your customer.
Kind of
That's
background check.
That's correct. That's correct. So, which also means they check your eligibility of taking a loan. Sorry. So you've got your credit points and that there's a credit score that you're allocated, or depending on your spendings and the ability to repay a loan. So when all of these measures are not followed and these metrics are just ignored, and you give anybody the kind of money they ask for, then you have reckless behavior. Most of them started investing this in the real estate market because it's guaranteed a return, which created this thing called a bubble, or which means it's exuberance, right? Like it's what happened to Bitcoin. Everybody was euphoric that, oh, this is going to touch sky high, but every asset has a limit after which it will crumble, break and fall. So that's 2008, and the 2008 crisis and the global recession is going to be a podcast in itself, where we've got to break
Right.
down multiple moving parts.
Fair enough. So I'm going to conclude this session. So from my understanding, so I'll start from an individual, where an individual is earning money, and sometimes the individual needs to borrow money from the banks, but then again the individual is also spending and then paying taxes. The basic an individual economy starts from how they are trying to make ends meet, and then individual is part of a society in terms, for example, could be part of a company does the same, pays its employees and also sells its product or services to the customers. Then there's a sector, then there's a state, then all together it's a nation, or maybe the world itself. The flow of money among individuals or companies, sectors, state, world, it's that's the economy of that entity. We have spoken about the factors like interest rates, need for regulation, how fluctuations in one end affects the prices in other end, and the cash flow in the economy all over. So my final question is, keeping all this in mind, what is GDP?
Yep. I mean, your summary was very succinct, but I would like to add one anecdote there, which is quite interesting because we're talking about economics. The word economics is actually derived from this ancient Greek word called oikonomos, Oikonomos. So oikos means house, and nomos or nemo means distribute, which can be roughly translated to household management. So oikonomos is household management, and if you get that one brick right, the entire wall is strong, because each individual brick contributes to that larger wall. So that's your summary was pretty much in line with that definition, because it fundamentally starts with that one unit, which is the individual or the family or the household in the economic sense. But leaving all of that aside, GDP in a sense is an aggregate of what the country produces. So when I say an aggregate of what the country produces, it includes both goods and services that it produces, subtracting the cost that it incurred to produce these things. So that essentially is the GDP. So it is the value generated by a country. So when you hear India is a $3 trillion economy moving towards the $5 trillion economy, I don't know how many trillion economy is the US, but it's undoubtedly number one right now. So when we say this, it essentially measures the value that the goods and the services generated by that country amounts to in the global scale. So simply put, that is what GDP means. But before we finish, because we might not necessarily be able to dumb it down, GDP has, you see, economists and people who are in the financial sector love using jargons. Okay, I think one of the reasons why they love using jargons is because we don't want to be left out from the science sector, because we don't understand what the sciences mean, right? So you guys talk about advanced thermodynamics and you guys all sound smart, and we don't want to sound stupid. So when you actually see GDP, you've got other terms like nominal GDP, real GDP, and all of these are flung across in the newspaper.
GDP, PPP.
Yeah, PPP is another concept. It's called purchasing power parity. But usually with GDP, all these fancy articles, you would be like, oh, GDP as measured by nominal GDP, real GDP. So it's all a bunch of, I know, like it makes sense. It makes sense. Look, it makes sense in a quantitative aspect, but I don't think it makes sense to a lot of people listening or reading commentary because of these terms. But simply put, nominal GDP, like we said, GDP in itself is the total value of goods and services produced, correct? So nominal GDP is what that value is according to current market prices, in the sense according to the Indian rupee that is being traded right now, which is 79 point whatever to a dollar. Real GDP is at a fixed amount, right? So we fix that, okay, considering INR is 75 at the dollar, what is, we have, that's why we have something called the base year. So we use the previous year's money as the base to measure the current year. But nominal GDP is when we calculate the value of goods and services produced at current market prices, which includes inflation, deflation, currency fluctuations, or whatever. So usually a fair measure, that is going to be a more accurate measure, nominal GDP, but it's going to be harder to calculate. So real GDP is what most people put out when you're comparing quarter on quarter. So I can't compare, let's say, if I want to measure GDP of India in the first quarter of 2022, and I would want to draw a comparison between the previous quarter. So I can't do that when the currency is going to be fluctuating so much because of certain crises or whatever. So like I said, this jargon just complicates things a lot, but that's all you need to understand.
All right. I think we are running out of time.
Yeah.
So thank you for answering the questions. So, and then of course expanding on it. So hopefully, I mean, this has been an interesting conversation for me.
I'm glad.
Hopefully it will be an interesting conversation for our listeners as well.
I hope so. Hope so.
Thank you everyone for tuning in. Until next time, bye-bye. Take care.
Guys. Cheers.